Bună seara, bine v-am găsit. Se aude? Ok, în regulă. Bună seara tuturor și bine ați venit online la programul Formare Profesională Continuă 2020. Numele meu este Decebal Todoriță și sunt consultant PR și marketing în cadrul As Financial Markets. Mă bucur să fiu alături de dumneavoastră pentru prima dată. Vă voi reține atenția pentru scurt timp înainte de a da startul efectiv al acestui program. În primul rând, vă mulțumim pentru că sunteți alături de noi și sperăm ca acest program să corespundă așteptărilor dumneavoastră. Ne dorim să cunoaștem impresiile dumneavoastră, ceea ce a fost bine, dar și ceea ce a fost mai puțin bine, ce doriți să îmbunătățim și în acest sens ne puteți scrie mesaje și comentarii în social media, pe pagina noastră de Facebook sau pe cea de LinkedIn. Ne găsiți foarte ușor cu numele de As Financial Markets. De asemenea, ne puteți ajuta cu un like, follow sau chiar tag. Totodată am dorit ca întâlnirea din această seară și toate întâlnirile noastre să fie interactive și dinamice și vă rugăm să participați activ, să puneți întrebări și să vă expuneți opiniile sau să cereți explicații suplimentare când considerați că este necesar. Aș dori acum să-l prezint succint pe lectorul de astăzi, domnul Mucul Pal, pe care l-ați cunoscut la prezentarea sa anterioară. Voi face o prezentare scurtă în limba engleză. So, hello Mukul, welcome. Thank you for sharing with us your vast experience. I'm going to make a short presentation of you and then we can start the program. Mukul Pal is an entrepreneur with over 20 years of experience in investment and consulting. He studied science and business in India, followed by a master degree in economics and statistics from Babeș-Bolyai University in Cluj. He also studied financial technology at the Massachusetts Institute of Technology, MIT, and he graduated the class of 2016, FinTech class. In Cluj, Mukul Pal has been active in business consulting with his profile company, Orpheus Capitals. Orpheus is MIT-ranked FinTech and one of the world's best AI innovator. The company specializes in artificial intelligence solutions for the financial services and other sectors. In February 2018, Mukul Pal founded also Alphabots, which operates in the United States, Europe, and India, and has its headquarters in Toronto. Thank you for your time. I hope that you will be active in this evening and ask a lot of questions. So now I'll pass the microphone to Mukul. Good luck.
Thank you very much for the introduction, and thanks again for the opportunity to speak to such a great audience. And I have a history with them, and I'm excited to talk about the subject. We're going to today speak about Alphabots. Alphabots is a very generic name for alpha and robotic processes. So if we combine robotic processes with alpha, which is the term which we use for excess returns above market, that is where we come to Alphabots. And we believe, and we are working on this vision that the future belongs to machines. In future, the machines will help a lot in decision support regarding managing money. And as I mentioned on my last talk on general AI, that the future is also about machines fighting other machines. And this is why we are consistently working on this idea and seeing how we can build machines that can extract intelligence or extract value or extract alpha from markets. So my presentation is in three parts. The first part is called the fruit basket paradox. Um, and because we are dealing with baskets, and because the process is very general, um, I chose to call it as a fruit basket paradox, and I'll explain it, further in as I go. The second part of uh, my presentation is about factors. Factors are how investment management is done today. Factors have become mainstream. Factors is a culmination of variables or reasons um, of modern finance to explain how markets work, how how portfolios work, how portfolio returns are driven, what drives these portfolios, and the third part is where I talk about the future, explaining how the paradox and how the factors culminate into building machines. Um, so, fruit basket paradox is a, is a very simple way of explaining baskets, and baskets is not a problem that we are trying to solve from today. We are solving a problem of baskets for a long time, and baskets is whether we call it an urn with balls, or we talk on various thought experiments. But the idea of building a portfolio is something very similar uh, to putting our hand inside a sack of balls, and there are black balls and blue balls and red balls and golden balls, and to develop intelligence where one can keep putting his hand inside the sack and keep extracting the golden balls. Keep putting the hand inside and keep extracting the golden balls, whether it is with replacement or without replacement. uh, these are also things we can delve into, but the whole idea is how to build systems which can um, smartly identify or pick up golden balls without looking inside the sack. Ultimately, markets are like a problem, right? Market is a basket. It has a lot of things to select from, and and our idea as asset managers, our idea as investors, our capability as investors is about being able to select, and how to select smartly, how to choose smartly, how to pick the winners is what investment management is as a primary consideration. This is what investment management is thought about. There are more aspects here which I'll build on in this conversation. Um, but before I start and before I build into baskets and portfolios and investments and investor and risk and preferences, I want to make a very important foundational point. This foundational point is called the law of ruin. Law of ruin was a term coined by Jules Renault somewhere in 1861, and Jules Renault was an assistant to a stockbroker, and he preceded um, in the thought process of random walk before it was talked by Einstein, and he inspired many thinkers, and his work is in French, and there are translations available, but there are some English papers in English written about his research. Um, and he's talked about law of ruin, and I think it's a very important historical context to be highlighted. I myself have come from a trading background, and I've come from a extensive trading background. Means at some point of time I used to look at data on a tick basis and data on a minute basis, and markets have an ability to capture us. Markets have an ability to engage us, indulge us. Markets has an ability to um, take a lot out of lot out of a part, somebody who takes part in it. And it took me a while through this journey of trading and analyzing and thinking about structures to come to ideas and experiences to come to ideas like this. And somehow I was already on the journey of looking at investments in a different light than trading. But when I read Law of Ruin, it reconfirmed the idea. So what is the law of ruin? The law of ruin is that the losses that you make in your stock market transaction are a function of the frequency of trading, which means that the more frequent you trade, the more possibility or probability of loss. So transaction costs, of course, the time of Jules Renault is different than now, and transaction costs are less. But even from an alpha perspective, which is our focus, how to get optimum return, how to get optimum profit, how to maximize profit, the the it is this is still an important historical context which explains that more you trade doesn't necessarily mean the more maximizing you will do of your portfolio or of your transactions. And it may be very stark, but in this time of inability to understand structures or inability to understand markets, inability to understand information, what is happening, why is it happening, how does markets work, in this all chaos, somewhere slowing down is a virtue, and slowing down is extremely difficult and not easy. But investments and investment management and holdings and durations and the art of um, uh, art of not being impulsive, not letting emotions get the best of you, uh, is still very important. So this is the law of ruin, which I thought is an important foundational piece before we start. Of course, high frequency trading is also an art, and high frequency trading are today done by robots. So for whatever you are doing in terms of high frequency, you may have to be aware that machines may be your counterpart party. And I do not know whether you are aware of this, but um, uh, co-locations co-location or being closer to the stock market data to get the multi-millisecond advantage, to have information before anybody gets it. These also are infrastructure and technology play in terms of robots and machines understanding order flows so that they can place their orders before and anybody else. These While this is happening, there have been exchanges built which say no, everybody should have a fair chance. If everybody has to have a fair chance, a, s- a speed bump was built by one of the exchanges in Toronto, um, ICX, um, and and what they did was they built a speed bump so everybody stops at the speed bump, and then they have no speed advantage of getting information, and then they execute. So this slowing down process is of building a more fair market is not just about investments per se, but it's also about ethics per se, in terms of how everybody gets information at the same time. And there is, of course, another Eric Rice, um, Aries Rice, who says that there is a need for a long-term capital market where it is not about quarterly results. It's about creating real value rather than quarterly value. So the whole idea of slowing down is not something which I'm insisting here as something new. It is historical, and as we know that emotions or impulses are very high, and I have been involved in also teaching earlier in those days in early 2000s, late 2000s, when there were a lot of education happening in Romania in terms of capital markets. And I, I recollect teaching about psychology and how psychological behavior is very important, and why is it important to, you know, um, like how there is like how investors are full of misconceptions, and how it's important for them to understand themselves, how we can understand not to hurt, not to rush in. And this has been my background, and of course, while I teach and while I talk about it, it's also helps me subconsciously ingrain these things, and even starting a fund, when you finally eventually start a fund, you have not looked at markets on a day-to-day basis over years, and you are teaching people not to get to learn that detachment, that balance. um, it's always good to revisit that via how is wealth really created, and we know about Warren Buffett, and we know about long term investment, we know about buying in, having the courage to buy when markets fall 35%, and so on and so forth. So it is these aspects can never be underemphasized. And as I said, robots have already automated a lot of these high frequency work. What robots have not automated, or have not um, gone deeper into building machines, is the low frequency processes, and low frequency investing for a year, investing for 3 months, investing for 6 months, a longer period of time, for 18 months, for 5 years. And this is hard to automate um, because as we mentioned last on our last talk about general AI, that how um, AI is thought to be very data heavy, and data mining has to be done, and new data has to be sucked, and which again um, is why it's believed that more information is needed for AI to learn. And low frequency necessarily doesn't have a lot of data. Means if you talk about 10 years of history of stock exchanges, if we draw a list of the world's 20, 30, 50 stock exchanges, you realize that 10-year history is not something which one can take for granted. And if we go for 20 years history, then it is not many exchanges have 20-year history. And if you go for 30 years, 50 years, then it is only a few exchanges. So history is not there when it comes to analyzing long-term data, or historical data. So this is why it is harder to build robots on, or machines, or AI on investment processes. And what we are talking about, Alphabot, is an investment process machine. And so it is kind of counterintuitive, and which is what I was referring to in my general AI talk, where how you it has to be counterintuitive for it to work, or how out of the box thinking is needed, how we have to think more creatively about things, how we have to think on another tangent, because innovation is not about just extending the same idea, it can also be about thinking differently. um, so let's move on to the subject. So Alphabots, at the heart of the process, is an SSR process. SSR process means a scientific, systematic, replicable process. Science, as we talked about the funeral last time, that scientific theories advance by the death of old theories. And so there's always a paradox whether what is science today, is it science, is it not science, is it old, is it new, systematic, which is, we talked about nature and we talk about systems, organic systems, complex systems, multi-agent systems, and replicability, which is very important, because if you have a model that is very beautiful and it delivers and it looks great on paper, that necessarily may not mean that it is replicable. It is replicable in different market scenarios. It is replicable um, in different regions. It is replicable across different times. It is replicable in different interest environments, and that replicability is not just about an alpha bot. Somewhere replicability is also crisis in science. Maybe some of you have read about it, and if you have not, I urge you to read it, about the crisis in science. The crisis in science is that 70% of scientific research papers cannot be replicated. And if scientific papers cannot be replicated, I do not know what should I comment about non-scientific studies. And a lot of information you see on newspapers and you read in markets and you read about stocks are non-scientific, because they are just information. There is news, and news is not science. So if science has a challenge of replicability, a process, a system, um, an equation, and a mathematical foundation, if somewhere these create replicability challenges, then one has to really think how much it is beneficial to run after information. And of course, we talked about information also last time, how information goes through stages of relevance and irrelevance, and it can work, it cannot work, it may work, it may get neutral. We'll also talk about that. And along with replicability, there's another crisis in investment management today, which is why um, machines um, are coming, because ultimately science has to progress, and machines have to come. Machines are in our everyday life, and we use machines for doing so many things. Machines are not going to say this is stock market, so we are not going to enter here. There has been a history of research which is about building stock market science, and there is work done by Andrew Lowe, and who says that physics is dangerous to your portfolio health. And so there are a lot of resistance from economists. Andrew Lowe is MIT, and he has come with an adaptive market hypothesis, and explaining or convincing that science is not for stock markets. So this is it's a war. It's a war between the scientific thinking and the and somewhere the economists, who have first been challenged by behavioral finance, and Eugene Fama was quoted, Eugene Fama, 2013 Nobel Prize, father of modern finance, father of efficient market hypothesis, 60 years of work. And he was quoted about behavioral finance as saying that um, behavioral finance is a story of anomalies. And how did this ever get published? And then he ended up taking the Nobel Prize along with a behavioral finance practitioner, Robert Schiller, and who's from the inefficiency school. So the debate between efficiency, inefficiency, are markets efficient, are markets not efficient, inefficient. So this is a real problem of stock market science, whether it can be made science or it cannot be made science. So we are from the school of thought, yes, stock market is science, and machines can do the job, and it can solve the problem. So this second part, which I'm mentioning in replicability, is about beta, which says that 90% of asset managers after cost do not deliver more than 1% excess return above the market, return above the market at a risk weighted level. So over a period of 5 years, it is very hard to find asset managers who can consistently deliver more than the market. So it brings us back to the basket problem. We have the same basket. Asset managers are in business because they have to beat the market. They have to select better. They have to select winners, and they have to consistently do it. And if they consistently do it, that is when they add value, or compensate an investor for the cost. That does not happen, and this is a crisis in the investment management industry. And and rather, there are also studies which say that pension fund managers who choose asset managers, or who choose alpha generators for allocating money to them, the the best ones they choose tend to underperform. The ones they fire tend to outperform. So there is a sense of chaos, there is a sense of error. Search for alpha is a cost. And so it's a very ingrained problem. It is not just a superficial problem, it is a serious problem. And that is why there is a rise of the ETFs, and there is a rise of the passive. Just by the benchmark zero fee ETFs. And so the just because there are zero fee ETFs doesn't mean that it solves the problem, but it is, investors believe, why should I pay 1%, 2%, 3% for an active manager who doesn't beat the market? And and the whole idea of what to beat, what is beating, what is outperformance, how to judge outperformance, this is still a, a difficult language for investors. Investors don't really understand it. And when you have apps like Robinhood, where you have zero trading fee, trading cost, suddenly it's a free for all. And free for all means, like, you can make wealth, a lot of wealth every day, and you can lose a lot of wealth every day. And I don't know how many of you have been with me in 2007 and 2008, but it was a hard time for many investors. It was a hard time for many traders. There were a lot of losses. People lost their houses. It is this. The love for market is not a easy thing, and to find the balance with markets, it's a double-edged sword, right? So how to find balance, how to educate, how to learn, how to understand risk, it's a lifelong journey. So Spiva is run by S&P Dow Jones indices, and they run a Spiva scorecard. Spiva, if you search for Spiva, you'll find this information. And this information is very beautifully displayed on a web page. You can click on a region, you can click different regions, you can click countries, and you can see 5 year, 10 year, how many of the managers outperform the S&P 500, how many of them underperform the S&P 500. So you will get to that 90% figure as you will play with those statistics on the beautiful web page, to understand what I'm saying, or put a more factual context to it. Um, and of course, there was a funny story about Spiva scorecard, to just always also give you the other side of the scorecard. So S&P Dow Jones indices carried a very scathing report on Canadian asset managers, and they said, Canadian asset managers, active managers, did not beat the S&P 500 over the last 5 years, and they have been the worst performers. And they means, just to make a point that, see, active managers are not delivering. And then this was followed by 2017 I think it was 2017, um, Canadian markets were the best advanced markets, or the best ranked advanced markets. So when you throw away something, or you say something is not working, it's not very surprising that it starts to work. So even these scorecards which claim that something is not delivering and something is poor, can have a big surprise, but they don't talk about that surprise, what happens, right? So they talk about that what did not happen, but anticipation is a difficult task, right? Um so so these are um, some funny stories about how passive is not really on a great ground. Just because active managers are going through a challenge doesn't mean that passive is the solution. And this reminds me of Jack John Bogle of Vanguard, and who was inspired by Paul Samuelson's work of 1972. And he was in Princeton. He did his thesis, and then he based on that, or he did pioneering work in setting up the benchmark fund. And so the passive innovation started back in 1972 with John Bogle. And then he used to say that, we used to have parties and celebrations when $1 billion used to come in the fund, and those was great days for us. And then it started happening every day. $1 billion started happening every day. So how somebody who creates a market and realizes that how it explodes and grows, and even before Jack uh, Bogle died, he was featured in Bloomberg in a beautiful interview, and he said he was restating the fact that there's no point timing. Don't waste your time. Just buy passive. Active is not going to work, because factors will come in favor, factors will go out of favor, and you will waste your time. Value will die, growth will happen, dividend will come in, low wall will happen, low wall will go. So why to waste your time? Factors will revert to the mean. So just buy passive. Are you all with me? What I'm saying, is it clear? Is it difficult? Can you please let me know as we go ahead? I'm waiting for some feedback here. Okay, great. So the point I'm making here is about this not so subtle difference between passive and active, and understanding that um, understanding there is more than meets the eye, and it is not just a black and white structure. Active is still reasonably large. It is 62% of the market. So if we are talking $100 trillion, $62 trillion are active worldwide, 38% are passive. So though passive is growing because active is not delivering, but that doesn't mean that active is going to die. Active is not going to die. Active is going to survive. Active is going to thrive. Rather, passive uh, may have a moment of reversion, because it's a long only process. If there is an extended crisis or extended sideways action, long only will not deliver. Active has an opportunity to um, build build different kind of structures, build different kind of sector themes, build defensive sectors, build time active processes. Even have processes like which can go partially cash, 20% cash. 20% cash can go a long way in mitigating risk. 20% cash can be significant in terms of outperformance. And so 20% cash, or cash as a percentage, is not a feature of passive, because passive, you just buy the basket. You believe nobody can put his hand in and get the golden ball out again and again, again and again, right? So this is is a debate of our life, because economics is a reality of our life. Wealth is a reality of our life. We, as Herbert Simon said, are the economic men, right? And he said that we may not be perfectly rational. And behavioral finance, the subject he started, the future practitioners distorted it and said uh, investors are irrational. There is a difference between saying that you may not be perfectly rational to saying that you are irrational. But again, these are subjects or subject inconsistencies inside the same subject, where practitioners don't do enough due diligence of going back to the foundational assumption of the man who started the subject. So, uh, this is uh, this passive and active is a reality, and it is not that passive cannot be improved, because what is passive? Passive may be buying a basket, but it's buying a basket or building a basket itself can improve. And that is what is somewhere is in the middle of passive and active, which is called smart beta, which is extending the beta, extending simple rules so you can build smarter baskets. So there is a lot of subtleties that have come in smart beta as process or an investment exercise has happened somewhere in 2002, and smart beta has gone through its own revolution. And um, and smart beta is while it happened in US in 2002, it happened in, or it was being discussed in Canada in 2012. So even despite the proximity of Canada to US, ETF took a significant time to grow. Remember doing some road shows for S&P, meeting ETF strategists, talking about ETF based models, and there was a lot of plug and play process. There was a very slow growth in 2012. So smart beta itself went through a revolution where the founding fathers of smart beta, one of them Robert Arnott, uh, and came and he wrote a book, and it was cited in news as the fastest 100 billion to be um, following a style in 10 years. The fastest 100 billion in 10 years the was the stories around uh, Robert Arnott's Rafi fundamental index. And of course, after that 100 billion story, um, Robert Arnott had a difficult time sustaining that argument, and then the argument changed, and the argument got mixed, and Cliff Asness wrote something, and there's a whole war uh, uh, about what works, and what has and claims have been put out, have been thrashed by the market. Value went into a deep under performance against growth. So this is a it's a it has a large complexity in itself, and because it is so complex, that is why machines have a better chance to do a better job than what humans have been able to do, because there is already a level of maturity, level of complexity, level of understanding of what should be done, what is being done, what is wrong in what has been done, what was wrong which became right, what was right which became wrong, right? um, so so this is the ETF market. It has gone to now about more than 3.5 trillion. Maybe it's about 5 trillion, 6 trillion. And ETF's growth is a function of the um, interest in passive. Why should I pay 3% fees annually to the active manager when I can buy a Vanguard fund for no cost? So I just explained that this is not just a perfect world with an imperfect world. There's a lot of um, lot of hidden risks which investors don't understand in a Vanguard like model or an ETF like model. Because if you think about it, Vanguard doesn't claim outperformance. So Vanguard is just a basket. And think about it. What is the biggest way and the oldest methodology to build baskets? The biggest and the oldest methodology to build the basket is size based baskets. Bigger the size, bigger the weight. Market capitalization methodology. If bigger the size, bigger the weight, what is wrong with this? What is wrong with this is that if you have only five companies out of 500 which are above $1 trillion, then naturally you are just holding five companies, more than any of the other 30 or 100 companies that you may own. So basically you are exposed to those five companies also. So you can just keep on buying the rich getting richer, or you may think that am I really managing my risk? So the risk part is another thing. The investors on the street don't really think about risk, and that is why they are the one who suffer the most in times of a crisis. Because then there is a when you buy Vanguard, you're not buying performance. When you're buying Vanguard, you're not buying risk weighted performance. Or I'm not talking about Vanguard per se. I'm talking about passive ideas. And Vanguard has done a great job in bringing out this product. But where is the limit? Where is the line? Where does the size start damaging itself? Another thing, if the world keeps buying ETFs, what are they doing? They're buying the same things again and again, same thing again and again. If you have an ETF of technology sector, or if you have an ETF of large cap and you hold both of them, you are having dual exposure on it. So the whole idea of double exposure is basically um, creating further confusion in terms of risk, right? You are still with me, right? Understand what I'm saying? Perfect. So this is ETFs. And now if we look at the problem at hand is that active is 3 times larger than ETF in size. So if ETF is 5 trillion, 6 trillion, 18 trillion active, 20 trillion, maybe more, active is charging 25 times average. This is US rates. I don't want to even talk about uh, other markets rate. The most commoditized market charge about 25 times the rate of an ETFs. And 9 out of 10 active managers don't deliver outperformance. So this is an opportunity for machines to understand there is a significant market, understand that it is charging significant fees, understand that it is not delivering, and there's an exodus from the active to the passive. And of course, as I said, even passive is a great opportunity for machines and building a smart basket. But let's stay focused on active, because active is the one claiming alpha. I can give you alpha. I can beat the market. That is why you should pay me 3% more than the on your assets every year. And if you're in a hedge fund business, if I make you more than if I make you real performance absolute return, then you have to pay me 20% of that performance, and in some cases it's 50%. But again, these are very few names. You can count them on your one hand, like Renaissance and I don't know whether there are significant names out there, but there have been hedge funds who have given more than 10%, 15%, 20% non-leveraged over a period of 30 years, but there are two or three of them. So alpha is the game, and commoditizing alpha is a large opportunity that we are working on, where we can build machines that can give, at the same risk of the market, an alpha, but at the cost of Netflix subscription. So because ultimately machines are going to commoditize, and anything which uh, is programmable, anything which is scientific, anything which has rules, anything which has logic can be commoditized. And I refuse to believe that markets are all chaotic and illogical and errors. And that is why we are understanding, and as I explained in general AI, that our focus is on understanding error, our focus is on understanding systems, our focus is on understanding behavior, our focus on understanding structure of data. So there is a way to the madness, and so that's what we are building or focusing on. uh, and this has been a journey for us. We have been on this for quite a while, and I've been in capital markets from 9th June 2000, and so I crossed my 2 decades of journey. I'm happy I survived multiple crises. I started work in a crisis 2000. Then there was a crisis in 2002. Then there was a crisis in 2007. Then there was crisis. There's a crisis happening all the time, and just surviving that and still doing what fascinates you about research, about markets, and coming to a stage where uh, now we're in the thick of things with a long short model, low frequency, unique process of our own. It's one has to be thankful that it did not destroy you. It could have destroyed you, but it did not destroy you, and somewhere you had the fortune to stay alive, right? So in 2014, after a series of iterations, I launched a product on Nasdaq, and it's called RMI VG20. It's searchable on Google, and RMI VG started with a small outperformance against the Nasdaq benchmark, and over a period of 5 years, it delivered 170%, while the Nasdaq benchmark delivered 65%. So it's a beautiful model. It has gone maybe through 2 iterations, and it rebalances average um, more than 9 months. A part of it is balancing longer, a part of it is balancing shorter and shorter time frames, and it was a great experience to launch it, to let Nasdaq validate it, calculate it, list it, and you can find the details on the Nasdaq website, where they have done a 10-year simulation behind from 2004 to 2014. Then they listed in 2014 August, and then so this history I'm showing you is the live history of the product. RMI VG20 ended up beating the award-winning Morgan Stanley fund. It ended up beating IBM Watson AIEQ, which has maybe a 1 year, 18-month history, and and it was a great experience to see, and the model delivering, bouncing back, recovery. Whether it fell this time, also it fell, it bounced back forward. So the recoil, how the robot was able to select instruments, the golden balls that recoiled fast. It doesn't have to be. It is not a absolute product. It's a relative product, but it delivered, and that gave us more courage as we kept building machines, that we have something which we should persist on. We should give it all our best. We should keep going on. So you should search it whenever you can. Um, so the Alphabot context is for us more of a intelligent service, and intelligent service is not something you use as a search engine. An intelligent services that you can talk to it. So you talk to it, you chat with it, and now conversational AI has significantly grown, so we can have a conversation, and even voice bots have become a mainstream. So you can talk to it, but of course you cannot talk to Siri about your investments, and but with the what we are building, you can talk to it about your investments, and you can talk to about what you want, why you want it, what is your risk you want, what is the basket you want. So it basically can ask you, what do you want to beat today, what is your basket, and what do you want to beat. And it can build that portfolio for you, or or it can ask you, what do you want to lose today. Now, one may think, why will an investor ask an alpha bot, a chat bot, build me a model that will lose the S&P 500 today? The reason this is an important question is because building consistent underperforming models is also science. While building consistent outperforming models is a science, the model or the framework should be invertible, so that what selection criterias are about finding winners is also about going in the bag and finding red balls which are always red and always losing. And it's important that you should understand how to build consistently underperforming model, because you should know, what should I not buy today, what I be underweighting today, what sector should I close today. How so these are beyond a simple set of questions for investors. Investors have not is the most underserviced class. If you are not a high net worth investor, if you're not a $1 million investor, if you're not somebody who has capital of $10 million to lose, you're an underserviced class. And if you're an underserviced class, you have not been trained to ask questions. So fortunately and thankfully for technology, you can ask questions, and technology is replicable, so it has no problem, it has no incremental cost to answer your questions. So you can be serviced, or investors can be serviced, or asset managers can be serviced uh, at a fraction of a cost, and given the courage to ask the questions. S- and the but the losing is important, as I said, also from not only context, from a model building context, which says that it is not just about smart portfolios, it's also about dumb portfolios. It's not only about smart beta, it's about dumb beta. How smart is your model today? Ask the 10 or the 100 AI companies doing a work like us, and you can differentiate them from the others if you can ask them, is your model invertible? You claim to make smart portfolios. Can you make stupid portfolios? Can your model identify losers as it identify winners? If it can do that, then you can put a checklist that the model has replicability. The model has invertibility. The model is a framework, because you can invert from smart to stupid, and you can find what are the worst sectors, what sectors you should not be in. I wrote about it in my on my blog, is in the headline of a smart inverse. And what I'm saying, this is a few years back I wrote about it, and I said that if that short design is important, understanding that what can underperform is important, and it's a test of model, it's a test of quantitative system. If there are AI managers out there and quantitative managers out there who cannot build this model, that means their model is not invertible, it is data heavy, it is pattern recognition, it is not behavior, and there is a possibility that what is working today may not work tomorrow. And that's the reality which we are facing today. Hedge funds have the biggest crisis, sustainability crisis, the biggest exodus. The whole reason why passive is growing, because alpha is not being generated, and alpha is not being generated not because that alpha doesn't like asset managers, but because the models that they use and the systems that they use are suffering from the Campbell and Goodhart curse. If it is known, it has a possibility of not to work. It will work for some time and then it will fail after that. So, how to build systems that we do not have to necessarily go in a system, oh, tell me exactly what you are working on because I want to sell it as a marketing sales pitch. No, the system is working because it doesn't want to explain what's inside, but it is the outcome, the replicability, the backdating, the cross region, the cross asset, the cross styles is itself a proof that there is a consistency to the method. So, so the alpha bots or a framework or machines that build investment portfolios have to follow a checklist or should follow a checklist, or there's a proof point to them. What that is, the models, they should be a framework, it should be invertible, it should be cross asset. It cannot just, oh, I my model only works on equity, my model doesn't work on commodities. You know what, my model only works on for foreign exchange, it doesn't work on real estate. So the cross asset nature is a big test. Oh, my model cannot work on bonds because bonds is another thing. How can every model work on every asset? Yes, it every a model can work on every asset. It can work in Nigeria, it can work in Brazil, it can work in US, it can work in Japan. Japan, the market that is a CAPM exception and very hard to model, always is an outlier. That model should pass the Japan test. If your model doesn't pass the Japan test, it has failed. Cross style. It should be long, it can be short, it can be long short, it can be long short combination, it can be long cash, short cash, and so on and so forth. It should be cross factor, value factor. Okay, uh, Alphabot, please build me, take S&P 500 value components, 300 components, and show me that you can build another 300 value component with the same 300. Show me that you can generate me excess return. Show me that you can generate me risk weighted excess return. So, Fundamental Index had a Wikipedia page. They still have a Wikipedia page, and their claim to fame was that S&P 500 beating S&P 500 with all 500 components, different weightings, similar turnover, beating S&P 500 risk weighted by 250 basis points every year. So if you would put S&P 500 fundamental index, you will beat it. But I don't know how much it has beaten over a long period of time because value died in the meantime, growth came, uh, the philosophy changed. They decided not to republish another book. I don't know. Means their whole the revolution or market or unpredictability or error happened, and the factor which was working failed, and new factors came in. So the whole idea of model functioning or model workability has to be cross factor. It cannot be married to a factor. It cannot say, I only work on value, I only work on dividend, I only work on momentum, I only work on volatility. No, you have to work on every factor. Tell me a factor which you want me to work on. Beat S&P 500 value with all the 300. Okay. Beat S&P 500 growth on the same 300. Can you beat it on 100? Selecting from 300, how much can you beat it? So the margin we are talking about of beating is no more 250 basis point. A machine has to do better. It has to maximize. It should not do just 250 basis points. It should do 400 basis points. Our S&P 500 version, our initial earlier version used to do 400, 450. So we said, you know what? We are doubling or almost doubling Rob Arnott's numbers. So at least we will have 1% of his business. You know, he's 100 billion, we'll have a billion. You know, that is a good market to fight for. So of course, execution, building, success, market dynamics, moving targets all put a spanner in your work and in your business model and in your business vision. So you end up, instead of thinking of $1 billion coming every day, you think of, you know what, let me build a Netflix model. You know, because the world is changing, the fees are changing, and if smart beta is charging 6 basis point, I don't want 6 basis points. on the assets, and by the time we'll get $1 billion, the whole market will crash. So you are forced to think, what is, you got a great process, great methodology, so how to make a business out of it. So cross domain is of course a general AI process when it decides, you know what, financial market is dead, so let's work on non-financial markets. Financial markets, conventional assets are dead, let's go to alternative asset markets. So the whole idea of surviving and sustaining and persevering and building machines despite odds is what the future is going to be. Are you still with me? Okay, great. So So to reinforce the point from last session of general AI can consider weak AI as a factor. Show us all the IBM Watson AI machine learning models in the world. We'll put them in a basket and we will tell you which ones are them are the top decile ones and which one are the bottom decile ones, which ones of them will underperform and which one of them will outperform. So weak AI suddenly becomes a factor. So that is how factor agnostic you have to be. And this is why weak AI is is ready and will be commoditized. Data heavy things do not have a future, because when it is data heavy, then it's information, and information age is over. And because we are in a conceptual stage, we are in a architectural stage, we have done everything we could do with information, and we can keep juicing it information and trying to do our GPUs and computation, or we can think, how can, is there a smarter efficient way to do these things? So the new age is a conceptual age. This is, I read in strategic learning book about it, and I have this book here with me. It's by Willie Peterson, Strategic Learning, and he talks about these ages and information age according to him, or according to the chart he carries in the book, is in 1980s, and in 2000s it got over and we are in the conceptual age. So it was a news for me when I read it, and I said, oh yeah, so means I'm not in a really a different time, I'm not really alone, I'm structuring things, I'm thinking so different, I'm thinking concepts. One of our um, old team members used to say, Mukul, your capability is conceptual thinking. And when I read it in terms of this strategic learning piece and this information conceptual age, it made me feel good that I'm not really out of place here. And there may be a possibility for us to survive. There may be a possibility for us to eventually come out of this burden of startups and burden of technology and burden of research, where you dare to think different. So, in generalized terms, a portfolio value should be nothing but a function of what to buy, how much to buy, weightage, and how long to buy. SWD, select, weight, duration, hold. And there should be nothing else. Whether it is factor X or it is factor Y, or selection is among factors, or selection is among regions, or selection is among assets, it's about your preference. What do you want to beat today? What do you want to lose from today? So this completed my first part uh, on the factors, on the fruit basket paradox, which was about a basket, which was about the fact that uh, that how can a fruit seller go into the wholesale market of fruits and sell them tomorrow and day after and next week and become wealthy. The only way for him to get wealthy is to anticipate if he's buying bananas for $1 in today, and he's going to sell them for $1.5 tomorrow, because banana prices have suddenly gone through the roof. How can he anticipate is the paradox, because he has to choose and build a portfolio uh, without the information about what will happen tomorrow. How can you build a basket and which can have the most optimum value tomorrow, because grapes are less and grapes value fell, and pineapples are more and their value rose tomorrow? So what is the how do you maximize a basket, a fruit basket, uh, tomorrow, and that you can only do anticipation? And how can you anticipate without the information of tomorrow available today? So that is the fruit basket paradox, and that is what my MIT business plan was, and that is what they liked, and and ranked me as the business plan is one of the top fintech ideas. And it's a strange story about MIT, because the MIT induction program started with David Schreier, who led the program, saying that alpha is falling, alpha will fall, pension funds will not deliver. So we are in an alpha reduction environment, and for me, what I was building was about an alpha increasing environment rather than a reduction environment. So now we'll go to factors. Are you still? Are you? Did you understand the first part? Can we move ahead to factors? Okay, great, awesome. So factors, as I said, is a mainstream today. Factors have come from modern finance. Factors have come from statistical regressions. Factors have a history. Factors have come from market is a sensitivity to market is a factor. Sensitivity to a dividend is a factor, and so there are many factors, and size is the biggest factor. And we have to build a machine in a factor agnostic environment. Factors is um, is what we are talking about in a factor agnostic environment. So it's important to go back in time and see how factors evolved. CAPM is a factor. CAPM is a model, a 1990 Nobel Prize, and created first in 61, 62. And just a minute, please. So CAP model, the pricing model, uh, was about sensitivity to market prices, and 61, 62, and 1990 Nobel Prize, the regression or the sensitivity to market was very important. Portfolio returns could be explained um, by the sensitivity to market. And this is another old paper, 968, Ball and Brown wrote a paper saying that accounting numbers uh, had an influence on stock market prices. And this was early days when fundamental ratios were started to get accepted, that books drive the process and ratios drive the process. And this was the beginning of the fundamental investing period. And as you know, 1950s was also the Graham and Dodd era, where investing was explained as an art and a science. Then this was followed by uh, arbitrage pricing theory in 1976. Stephen Ross, great work, brilliant work, almost no Nobel like work. And arbitrage pricing theory was about about non-systematic factors, about macroeconomic conditions, about regulations, how they can affect the pricing of an asset. And of course, it was about arbitrage. And so this was another model which was critical in the building of the whole process of pricing assets. Behavioral finance came in 2002, and 2002 was when Daniel Kahneman got the Nobel Prize on the endowment theory, and talking about there is no economics without psychology, and psychology as a factor came into being. And 2013 it was Robert Schiller, and Robert Schiller again said that the psychology was a real factor because psychology created bubbles and there was an irrationality to them, and hence the real way to understand market is as a psychology as a factor, though it was still an anomalies. There was not so much quantification. That was more of a study of investors misbehavior or misconceptions, their attachment, their pain with the loss more than the happiness with the gain. And then of course 2017 Richard Thaler, and Richard Thaler's work on behavioral finance, end of behavioral finance, and so these were the kind of history in terms of factor thinking, from financial factors and risk factors and market factors. And CAPM was extended by Pharma and French, which was about adding a small size factor, and it was about adding book value factor. So when small size was added, and that small size versus big sized is an efficient factor to deliver consistent premium or consistent explanation of the portfolio returns. And when book value, high book value minus low book value as a constant factor having a influence on the portfolio returns, CAPM model was extended. And when CAPM model was extended, then it uh, it explained more factors. There are more factors. There were Carhart models, and there is a study which talks about 456 factors, but there are a lot of factors. So post pharma in French, or there's a parallel work was always happening in physics, and there was subject called economic physics. I think this also is early 2000s, where Eugene Stanley from Boston University, director of polymer studies, started writing about power laws and earthquakes, and how the earthquake behavior can be explained in stock markets, how stock markets also show an earthquake like behavior. What he was trying to show was that how returns have a certain distribution which is similar to the distribution in earthquakes. And economic physics also went ahead and created new factors like minimal spanning tree, and how correlations happen, and how correlation can be built into a temporal space diagram, and how those can be minimized in terms of weightages. So a lot of meta factors were also happening, and continue to happen. So our human need to explain causality uh, keeps us engaged and keeps us involved. We want to find that beautiful indicator that delivers. We want to find that formula that can help us. But we always forget about the Campbell and Goodhart, that if there is a certain indicator you're going to follow for too long, it will fail. And that's what happened to factors also, that while one factor was gaining popularity, there was a conflict to that factor, that this the primary factor is wrong. And then while the second factor was gaining popularity, a third factor was saying that I'm more significant. So it's like factor wars, which became more complex than the war of inefficiency versus efficiency, that markets are they efficient or are they inefficient. Are they rational or are they irrational? So the whole school of thought that you cannot make a lot of money from markets because markets are efficient. If you're making gains today, you will lose tomorrow. So net net, you will not make anything. And then there is an explanation and proof point by inefficient school of thought that, you know what, there are the markets are inefficient and it creates a lot of opportunities, and which is why super wealth can be created, right? So this debate between factors and debate between efficiency inefficiency is at the heart of the non performance of the investment management industry, because we are using old science. We don't believe it is science. We believe there is no science. We believe there is psychology, which is irrational, and hence uh, there is it can never be made into a science. Robert Solow, economic Nobel Prize winner, had the courage to say in his Nobel Prize speech, economics science is not science with a capital S. So, understanding the vulnerability of economics, understanding the limitation of economics, is uh, is the foundation for us to build science on it. Now, of course, economists talks about how the models are broken, how the Philip curve is broken, and the the rottenness or the decay of economics is kind of getting visible, whether it is MMT or it is the the old monetary theory or the new monetary theory, or it is so this is there's a lot of chaos and conflict and confusion, which has ended into conflicting parties getting Nobel prizes. Like 2013 was Nobel Prize was awarded, as I said, to Schiller and Fama together, and um, and um, and one said that psychology is a factor, and other did not believe that psychology is a factor. Other believed that markets are efficient, and so not everybody has the courage, but I have the courage to say that these are erroneous factors, and in context of what I've already talked about in general AI, because information passes through stages of relevance, irrelevance, and um, sometimes I used to fancy me sitting between Thaler and Fama while they are having an interview, and asking Fama that Kenneth Boulding was your teacher, and Kenneth Boulding said this in his paper about information relevance and irrelevance. How did your information assumption not consider Kenneth's work? And I want to ask a similar set of questions to Richard Thaler. And it was kind of strange that I wrote uh, a counter argument to Richard Thaler's work in 2015. He got a Nobel in 2017. I wrote a counter argument to Schiller in 2012. They gave him a Nobel in 2013. I talked about Fama in French extensively, uh, took his data from French's website and recreated models that did better than the size premium and the book value premium, and that also led I saw that my work preceded the Nobel Prize given to Pharma. So it was a good feeling that at least I had an ability to select great researchers, even if I was still building machines that could select golden balls. So for me, it was very clear. I didn't publish the Pharma and French work because we realized that there was more need for us to hold on to it rather than debate about it for 30 years and keep explaining that, see how we are smarter. So the idea is really was never about showing that you are smarter, because you realize that if you find something and if there is something smart, it has got a noise in it and it will eventually fail. So rather, we should build systems which can move from factor to factors, uh, move from error to error, move from uh, more risk to lower risk rather than saying that we found a holy grail, because there is none. So it is probability as the heart of things. So if you have found a holy grail, it's like the boltzmann brain. It is in your hand and it's gone again as you hold it and say you found the holy grail. So you will never find the holy grail, because it is a probabilistic event. You will find it and it will vanish. So this is how we convince ourselves subconsciously that we rather focus on research and learning and building smarter machines which can beat other machines than trying to engage in a academic war, because it's a it's a vain exercise. um, so talking about conflicts, are you with me? You should I proceed ahead? So so CAPM is suddenly CAPM 1961 was challenged by Stephen Ross, APT, and he said, beta is not relevant. And there were also papers written by Beta is Dead or Alive in 1993 by Lakshinok. And there was a lot of papers. It's the history of modern finance is very, it's like a garbled message. It you cannot make sense of it. It's a circular argument. And even if John Bogle stands out and says it's a circular argument, you're not going to win in this timing thing, and leave aside John Bogle's assumption that rich is going to get richer and Apple is going to become 5 trillion, so just hold 5 stocks, uh, flies in the face of risk management. So, and I think he did exert and assert and did acknowledge the duplication and the replication of same components being bought again and again through ETFs, and creating a kind of uh, risk management nightmare. But even before his death, he that was all he did in terms of the acknowledging part. But there was not really making him change his mind that we could be reaching a bubble, or we could be reaching a critical mass that could implode. Because ultimately implosion is not a concern, or implosion is too big a concern which one asset manager can handle. Implosion is a concern uh, which only philosophers can have. Implosion is not a concern for investor. It's maybe a concern for asset manager, because asset managers stick out their neck to build alpha. Even if they fail, they're on a war. They want to do better, they want to aspire. So I consider myself an active manager, and I'm going to carry that flag proudly, um, because it is I cannot leave or change who I am. I am in the search of quest of alpha, and even though I'm building machines, I'm an active manager. So after CAPM was challenged by APT, APT is a non-systematic systematic risk, and the non-systematic risk with an SYS uh, is uh, is somewhere a circular argument, because macroeconomic, regulatory thinking, and factors that can affect a company and hence a portfolio are not easy to measure. And this is why APT never gained that popularity, because of the challenge of understanding those non-systematic factors, the challenge of measuring those non-systematic factors. So great work, Stephen Ross is who died a few years back, a brilliant mind at MIT, and and a lot of literature. So the great minds, and somewhere, even if there are challenges to work, I strongly believe the saying about standing on the shoulder of giants. So I though Mendel brought differed from this approach, and he never acknowledged the people who created things before him, because of which he got involved with Julia Said, because of which he got the Fields Award of Prize for Mathematics. And but I strongly believe that my work could not have happened if these thinking and this continuation research is a continuity, is a continuation process. So I have great admiration for for Stephen Ross, for Harry Markowitz, and for all these thinkers, and even for Rob Arnott, because there is a truth uh, to the process. There is a truth to the research. The truth may be fleeting and the truth may fail, and that is for me to acknowledge, to build something on this fleeting truth as another overlay. But that doesn't mean that this is not great work. So APT never really got attention because of the measuring challenges of non-systematic risk. And then Montier came, a behavioral finance guy, behavioral finance expert and practitioner, saying that CAPM is scrap. CAPM is capital asset pricing model. He said it's crap because it's completely redundant asset pricing model. I don't know why. Whether I did not read very scathing work from Daniel Kahneman, but I read scathing work from Schiller. I read scathing work from um, Robert Thaler. I read scathing work from James Montier. So this need to ridicule is something I don't understand. Academic need to ridicule, but some of them have adopted this process, and I think James Montier is one of them. I could have said redundancy in another way. I didn't have to call a Nobel Prize winning work as scrap, because maybe that's not my style. So I wrote a paper and I explained why CAPM is not crap. And I wrote it and I challenged Montier in his work, and they have not given him the Nobel Prize yet. So maybe because he's more of a professional market expert rather than an academician. But I've written work on CAPM is not crap, explaining him that his words were not the choicest one, and why his uh, his claim that it is scrap is fleeting, because if you see the left box, there is risk. Small r is risk and big R is return. And conventional economic theory says that lower the risk, lower the return, higher the risk, higher the return. That is why this line going up. And Montier said, I did a study, and sometimes low risk gives high return, and sometimes high risk uh, gives low returns. And and so the so he said that is why CAPM is crap. But the in my paper, what I wrote was, I explained that this angle, rising angle to falling angle, has many more cases. It can be a flat line. It can, before it goes from a sloping positive to negative sloping, there are a lot of slopes. So it's a whole spectrum of slopes. So what is scrap may start to work again, and what is working may fail again. So it is not about it is wrong. It is just that the whole spectrum of slopes have not been seen. So that was my argument against that paper. And then uh, for pharma, I have respect. And one of the reason I have respect for pharma, of course, 60 years research deserves a lot of respect. But one of the unique reasons I have a great respect for Fama is because he said in one of his papers that somewhere his small size factor is unexplained. He talked about 1980s bear market, and he said that size factor is sometime unexplained. I cannot explain it. And I think that openness to to say, acknowledge that these are not golden lines or lines drawn in stone, this is research work, is sign of great maturity. I think, though, at some point of time he also retracted, and he said that he should not have said that behavioral finance is a story of anomalies, and it's this, how did this stuff ever get published? But there is a certain academic arrogance that is expected, because if you are brilliant in your work and you are doing path breaking work, you get a sense of arrogance, and which is human. uh, and which is and now, of course, there is more research, and size effect is itself is challenged. And this is a recent Cliff Asness on his blog, AQR, which is a large asset manager, 100 plus billion, maybe 200 billion in assets, writes about in his update blog on size effect. This is AQR 2020. And but now what Cliff Asness is talking about in 2020 is again shows that there's not enough work done in the history in the past. uh, just because we are academics doesn't necessarily mean we are also historians. And uh, reading history and going back in time is needs a lot of effort. It's like a it's it's like a detailed forensic work. And somewhere my um, um, opinions have been driven because I go back in time and I go back to history and I read the first paper and the first assumption. And and Bands 1978 talked about that size could be a proxy. Size as a factor could be a proxy, which means market. He's talking about size, not talking about small size. He's talking about market as a factor, M cap as a factor, could be a proxy of something else. And he's writing in 1978. And then in 1962 or 63, 62, 62B papers, pharma is talking about that this factor would be unexplained. And an AQR, Cliff Asness, is talking about in 2020. So it's again, one feels that, like, that it's kind of revisiting America. You keep going to the shores of America, like Columbus did, and say, "You found it again. I found America again," and they keep finding it again. And there's a paper called "Revisiting Willis," which is about physicists, and it talks about preferential attachment, about the mathematics of rich get richer. And recently, um, um, Laszlo Barbash, um, a fellow Transylvanian, not last year, but a few years back, got featured in the Newsweek. The man who can change tomorrow, the man who is the biggest thinker on networks and complex networks, and he's run some new maths on rich get richer. And then there's a paper talking about his work, and then they highlight from 1800s, uh, 10, 15, 20 researchers who have done the same thing. And he says, you know what? Physicists suffer from this uh, favorite pastime of finding America again. And I would agree that this is a similar phenomena that you see in finance. Means if Cliff Asness writes in 2020 that there's no size effect, I'm like, it's a 20-year-old, 30-year-old work. Like, okay, means maybe you should have read the paper. We could have saved 20 years of your research life. Like, so it's a it's sad that if there is something we don't learn, which we don't learn from history, is that we never learn anything from history, right? So it's very much true with the academic work also. So value is dead, and long live value, and dividend is, and growth is here, and growth beating value. Means that the question one may ask is this really science? Means I talked about science based on funerals, but this is not even science. This is a study of regression and coefficients, and there's no complex system here. This is linear, and we keep finding linear relationship, and we say, aha, wow, and we keep writing about it, and then we build such businesses around it, and we don't ask the basic question: is this science? So the point I'm making here is that factors are erroneous. Factors are in a war, and factors have a history of war going back 1960s. I've written a paper called The Size Proxy in 2015. You can find it on my blog where I've made a table. This guy said about size is a proxy. This guy said size is a factor. So the whole idea of contradicting research, not one guy contradicting another, a sequence of contradictions, affirmations, contradictions, affirmations. So it's just a pastime, and this is why science is not replicable. If statistics was replicable, if we would call statistics scientific, if statistics has a challenge of replicability, what about science? What about pure science? So it's a difficult, very thin, very superficial world of research we are in. Then I wrote another paper on reversion diversion hypothesis, where I explained the same idea about inefficiency, efficiency of a history of school of thought, which is saying markets are efficient, markets are inefficient, markets are rational, markets are irrational, right? So there's no point even highlighting those researchers and thinkers who have spent so much time writing and making their claim, and another one countering them. Of course, counter and claim argument is there, but should we not, after 70 years of think, okay, we have been fighting on it for so long, let's think something else. Let's think about how to solve this problem. Is there a reconciliation? Are we looking in the wrong direction? Do we have to really wait for each other's funeral, and can't we really go to the next step of thinking differently? So, and so somewhere this is one of the papers which, or an idea which I liked a lot, and I thought it explained a lot about what's happening. And it's called drift. Behavioral finance studied drift, and what it drift meant was post earning announcement drift. When you have an earning announcement, then after that earnings announcement, there's a drift. Drift means that that positive announcement keeps staying in the system, influencing the stock price positively. And it has been seen that sometimes those drift longs last for 2 years. And I really like the idea of a drift, and I like the philosophy of that idea. And it was written by Bernard and Thomas back in 1990. But again, it kind of confirms the same thing with Kenneth Boulding, a big thinker. A lot of people do great work, but not everybody gets a Nobel Prize. Of course, I'm biased towards Kenneth Boulding, but Kenneth Boulding is one of those contenders who should have got a Nobel Prize. So great work. 1966 talks about information relevance and irrelevance, but he's talking about information relevance, irrelevance in 1966. And Bernard Thomas is talking about information drift in 1990. And Boulding is talking about information relevance in 1966. And Pharma is talking about information irrelevance in 1960s. By the time, while Kenneth Boulding is his predecessor. So the point here is that if information has a drift, how do you quantify it? Can you pinpoint it? Now this 2-year relationship, first 3 months is going to have great impact. Second 3 months is going to have less impact. Now after that it's going to have great impact. So because there is a fluidness to it, it is very difficult to understand when information will be relevant and impactful and when it will be not. So that is what Kenneth Boulding said in 1966. It goes through stages of relevance and irrelevance, and that is why information is hard to quantify. And where do factors come from? Factors come from information. Where does information age come from? From information. Where does conceptual age come from? Post-information age, when we realize that it is hard to quantify information. Now that's a very big claim. How can you say that, Mukul? How you cannot go to a conceptual age? You cannot stop looking at television and news. It's so relevant. No, it is not. It is not relevant. Victor Nedhofer talked about the famous Berkeley hedge fund manager. He took the Wall Street Journal and he took headlines and he said, let me see how these big headlines are going to influence the market. So big headlines, which is supposed to have a significant impact, had a 17% times impacted more than 1% of the prices. So Wall Street Journal doesn't know what's going to happen tomorrow. So news goes through stages of relevance and irrelevance. So instead of running after information for relevance and irrelevance, you rather look at information structure. It's going to save so much time. So, like same thing about price earning. High price earning delivers returns. Low price earning doesn't deliver return. Then Schiller came up with the idea in 2005. You take the worst price earning of 10 years and the best price earning of 10 years, and they have an inverted relationship with returns. Uh, the scale and the slope changes in price or earnings, and the best price earnings invert in time in the next 10 years. The worst price earning invert in performance in the next years, right? Ultimately price earning is connected to returns. So the whole idea of inversion again brings back to us to uh, Montier's work, that CAPM is scrap, but Schiller is not doing that. Schiller is not saying that, and Schiller has been more elegant in scathing. And I read one of the pieces where he was making fun of sunspot cycles and how foolish this research is. So anyway, I have my views about Schiller's work, and by the way, I also wrote a paper on Schiller, as I mentioned, about his work and explaining that his non-normality or his unexplained fluctuations that he talks about in 1981. I think this was one of his biggest papers, which basically drove him to popularity and got him a Nobel Prize in 2013. And he said the markets keep oscillating around real value, real discounted value. So markets are really have unexplained fluctuations which cannot be explained. So it has to be behavior. And so what I did was I took his data and I created temporal structures around it. I extracted time around it. This was written by Paul, Mitroy, and Shaw in 2011, and in that I explained that the madness was not just the madness could be explained uh, in a temporal structure. Madness could be explained in a statistical distribution. So the question I asked him was, is it a non-normal behavior, or is it a non-normal temporal structure creating the behavior? Is time creating this madness? Is cyclicality creating this madness? Is there is a distribution or in the structure in that behavior, which is the reason it is expressing like that? So anyway, so this is one of the Schiller paper, 2011. After two years, as I said, he got a Nobel Prize. End of behavioral finance. Thaler. Richard Thaler is again brilliant work. Means I cannot hold a candle to these guys, and I think that I've come from stages of appreciation to questioning. So I have embraced the teacher and I've learned from him, acknowledged him, and then questioned him. So when I wrote a paper, I had read a lot about Thaler's work, and I think in 2000, I wrote multiple papers with Thaler's work. I wrote one on D Bond and Thaler, that stock market cannot add and subtract. I wrote a paper on that. That stock market, an opinion on that. And second was this end of behavioral finance, Thaler 99, where he said volume, volatility, dividend, equity premium, predictions, they really cannot, these are inefficiencies, and that is why the subject of behavioral finance, we can pack it and close it, because it is end of behavioral finance. We have found everything that had to be found on behavioral finance, and there's nothing more research to be done. So end of behavioral finance is a subject here. 1999, we are so intelligent and so smart that we don't need to do any more research on it. So I wrote a paper on it, and I said that what he's talking about, those five factors, which is equity premium price puzzle, dividends, volatility, their inefficient behavior. Why do dividend stocks get a premium? Why equity as a asset class is at a 6-7% premium over debt, and volume and prediction cannot be done, and so on and so forth. He basically, I I said in my paper, my counter opinion was that what you're talking about, is it not failure of reversion that you're saying is inefficient? Because equity has not till date given less return than debt, or it has still at a premium, which you feel can never get into a discount, is the reason you're saying this is behavior, there's nothing else. But I'm saying that what if this is a statistical expression that has not yet happened? What if just because failure to revert has not happened doesn't make psychology is a factor? The what if it is an error? What if in the next 10 years equity premium will vanish? What if the premium we give on dividend stocks will vanish? What if investor education goes to a point of stage where inefficiencies will vanish? And then we will write a paper that the misconceptions of investors have changed because investors have become very smart, they become very intelligent. So the this is a new era for behavioral finance. So rather than writing that, why can't we question and say this is a more of a statistical law failure rather than psychology as a factor? So I wrote that paper. And are you still with me? I know we are kind of getting into our last stretch. Please bear with me. Uh, the later part is going to get simpler as we go. Are you with me? Are you understanding what I'm saying? Okay, great, awesome. Um, so this is the part where I'm talking about, say, three factors A, B, C, and I'm saying if there are A, B, C factors in time zero or starting point, and then how do you know that A factor will become bigger, B will stay the same in weightage, and C will become less prominent? And how do you know in time T2 or in the final stage that C, which is small, will become bigger and A will basically shrink and B will also shrink? So this factor anticipation is very hard. You cannot anticipate factors. Is the FANG going to become successful, keep going to the moon? Will oil keep falling down? Is industrials going to reinvent itself? What's going to happen to the 10 sectors, 20 subsectors? How are they going to evolve? It is factor anticipation is very hard. You cannot anticipate factors. So if you cannot anticipate factors, then why do you keep telling me that factor A is brilliant and please put money on factor A? Whether it's factors or it is sectors or it is subsectors or it is meta factors or it is minimal spanning trees, ultimately it's a variable, and we have no way of understanding whether a certain variable will exist tomorrow or not exist tomorrow. Financial services have shrunk as a sector. How big it was in terms of 35, 40, 50% of the economy to less than 30% of the economy. The retail sector has gone through the roof. One company, Amazon, holds 30% of the retail of the world, or retail of US, right? So, or 23%. So it's a different understanding, or a different difficulty in understanding factors. So let's come out of this factor debate, my factor versus your factor, right? So this is why if you look on the Google and search naive diversification beat all factors. If you just naively diversified, it's like the monkey throwing darts has a higher chance to also can get right the portfolio. But this is not just about monkey doing darts. It's about monkey throwing darts and successively beating the portfolio managers, because there is a process to their madness. So naive diversification beats factor selection. So factors, it seems, also suffer from a fruit basket paradox. So this was a kind of build up on the fruit basket paradox to show that factors are erroneous. And so investment management, $100 trillion market, beta and alpha is a plain basic explanation. Then beta, coming with a smart beta explanation. Factor 1 is smart beta fundamental index. Factor 2 is um, small size factors and book value factors, and then we know that factors are in favor, they go in and out of favor. So basically, market is nothing but beta and errors. There is a beta and there is a divergence from the beta, and beta itself, as we know, is dead, or baskets can be built smartly. And if smart beta has a consistent system, then that will become the market. If fundamental index was a consistent system which continually beat S&P 500, then it would have become the market, right? And but it failed to become the market. So my explanation is that it is not about smart beta, because factors succeed and fail, and that doesn't help me make wealth. And there is a reason I just explained why it's a failing exercise. So the way to explain uh, divergences from market is about errors, error positive and error negative. So so this is a simplified solution, or a probability flow chart, as you may call it. And E is error, and error can be positive, error can be negative, and inside that positive error there can be a second generation further increase in positive. Apple was not $1 trillion, it was 900 billion, then it became trillion, and then it decided to become 1.1 trillion. So plus plus, error keeps amplifying. And because ultimately you cannot all call it value. How do you value Apple? You cannot value Apple. You can give it overvaluation, undervaluation, subvaluation, whatever it is. For me, it's an error, because it's going to go up, it's going to go down, it's going to fleet. My process, or my machine, or the machines we are building, is about how to understand whether plus is going to follow by plus, or plus is going to follow by minus. If there is a negative error, oil has fallen, will it going to fall by further negativity, or going to come back? So if we talk about a probability matrix, it's about equal. If we say it was idealized market, it's 0.25 each, which means if I sum it all up and do not do any active management, it's beta. If I do active management, I constantly search for plus plus, I'm maximizing my profit. If I'm shorting and I'm a short fund manager, and I teach machines to find minus minus, I'm shorting and I'm maximizing my alpha again. But if I'm not using machines, or if my discretionary system is not able to isolate plus plus, I'm going to look for plus and it's going to become minus. I'm going to look for plus, but I'll find minus. So this is one of the reasons, if we would look markets mathematically, probabilistically, then we may have a chance to find plus plus. We may have a chance to find minus minus, but it is not going to happen through information. It's going to happen through information structure. It's going to happen through defining the problem mathematically and scientifically. So now we come to the future. So the future, are we clear? Are we is it difficult? Is it easy? Am I boring you, or am I exciting you? Exciting. Okay, great. I am expecting a negative answer also, which is boring. So it is. It will be a great presentation if we have plus plus and minus minus achieved. So future. So future is very simple. We have to go back in history. This is a Millennium Prize problem called the Navier-Stokes problem. It defines fluid dynamics. It defines turbulence. 1821, an unsolved problem, $1 million prize on it, and it's fluid dynamics. One side is physical barriers, viscosity, turbulence on the other side. And this equation was taken by Buzinesk in 1897, and he generalized it. He generalized Navier-Stokes equation to simplify it, and while he was generalizing it, inspired Louis Bachelier, who took inspiration from fluid dynamics and created a linear regression equation, which ended up creating our CAPM models and creating our APT models and inspiring Paul Samuelson to build modern finance. Paul Samuelson, Nobel Prize winner. So it's crazy that fluid dynamics science inspired 1900 Louis Bachelier with the Boussinesque approximation inspiration. Boussinesque was his teacher. I hope I'm doing justice to the name. And and uh, and I told you about Louis Bachelier. He he had a bug in his PhD work, and and he was frustrated, and his work didn't do justice to him in his life. And it was true even with John Ray. John Ray's work I mentioned last time was a predecessor of Adam Smith. I wanted to say he followed Adam Smith. He was after Adam Smith. Adam Smith was his predecessor. So, and John Ray was also frustrated. He was in Canada, and great work, and just doesn't get visibility. So, that is why we don't seek visibility. We want to build machines, because visibility, academic life is very, very hard. Great work, and you can get noticed after you die. What's the point? Uh, so Bachelier did this work, and then if you look at generalization of Bachelier's work, this is APT, a summation of sensitivity to non-systematic factors which are driving excess return. If you look at CAPM, sensitivity to market as a factor driving excess returns. If you look at Pharma French, sensitivity to factors, small size factor, value factor, summarizing a set of factors, whether it's Pharma French or Cata, or five factors or other factors, Carhart, it is still a summary of the Louis Bachelier equation, or or somewhere the fluid dynamics equation. So basically, if we generalize it as we were generalizing before, excess return is basically a function of summation of a portfolio value which is driven by a certain sensitivity to a certain factor. If we continue to look into this, and problem for AI or problem for Alphabot is about maximizing or minimizing that function, which is nothing but what is a portfolio value. Portfolio value is what do you want to buy, how much weight you want to buy, how much factor weight it is, how much sensitivity it is, and how you want to weigh it, and how long you want to buy it. So select, wait, and hold. Summation of that and maximizing of that will give you smart beta, and minimizing of that will give you dumb beta. And this brings me back to that equation about maximizing the alpha, minimizing the alpha, maximizing is smart beta, but scientifically, not in a factor way, but in a factor agnostic way. Tell me what is the factors in your basket. Tell me what sectors are in your basket. Tell me what subsectors in your basket. Tell me your risk preferences in your basket. Tell me anything in your basket. Tell me sentiment in your basket. Maximizing that preference, smart beta. Minimizing that preference, dumb beta. And between the maximizing and between the minimizing is all that alpha. And which is not about a holy grail of indicator, it's about working in a factor agnostic way. It's about working in an informational structure way. It's about believing that there is no juice to be extracted from information. There is all the juice has been extracted, and there is nothing more to come, and it is only going to create noise. So working on the structure of error. And so this is how the aspiration is. Aspiration is whatever market scenario is flat, we beat the market, we underperform market is down, our losers fall more, our winners can still potentially should make an absolute gain. Markets are up, our winners beat the market more, our losers retain their NAV. Our markets go up and down, our losers continue to give value, our winners will deliver. So on and so forth. So that is the aspiration of Alphabots, to build machines that can work on all scenarios, that are more interested in extracting free lunch, whether it is 18% a year, or it is 20% a year, or it is 100% a year, on a low frequency environment. On a low frequency environment, whether it is what investing in first Jan and maybe rebalancing in next first Jan. Can we extract 100% from that possibility? Now, there are not machines which do that. Machines have to do a lot of work. Machines have to understand behavior. Machines have to understand information structure. But this is the aspiration. And when that aspiration is there, then you can maximize, you can minimize, you can get free lunch, sustainable free lunch, because there is nobody arbitraging it. Low frequency arbitrage is next generation. Shorting S&P 500 for 3 years, long Dow Jones for 3 years, and generating 30% return. A machine can do that. Machine can understand whether that can be done. Human beings cannot understand whether that can be done. Anticipation is nothing but intelligence. So this is the aspiration of Alphabots, and what it does is it listens to you, it cares for you, it asks you, what do you want to do today? You want to beat or you want to lose? And when you say I want to beat, then it says, it asks your benchmark, it builds your portfolio, it allows you to monitor that portfolio, it gives you risk attribution, performance analytics, price analytics, visualization, and it maintains it for you. After a month, it says, hello, I have your rebalancing. This stock out of your 30 stock has to go out, and this stock has to go in. That's maintenance. And so this is the vision of Alphabots. So I'm going to stop here, and I'm open to questions. Is there something in the slides which you want me to revisit? Something you didn't understand, and something you want to talk about again? Yeah. So I have a question here. Where is the question I can see? Hmm. Okay. Uh, okay, great. So I don't see any more questions. So I guess that's it. Thank you guys for listening to this marathon session. I really, enjoyed it. It's a lot of my research work that I was able to talk about here, present here, and it was a it was a good drill that we did. Good luck, and hopefully this will inspire you to think about investments in a different way, and and maybe um, adopt a smarter way, scientific way, systematic way, replicable way to do things. Once we will have the Alphabots ready, we will send out you an invite and you can try it out. Okay, okay, guys. Thank you very much.